Hey everyone, welcome back to Corporate Decoder, where we try to make sense of the madness that is corporate finance. Today, we're diving into a filing that shows a company wrestling with a common problem on the stock market, and it is not about to get any easier. So, we've got Intensity Therapeutics incorporated in Delaware, but based in Shelton, Connecticut. They trade on the very well-known Nasdaq stock market under the ticker symbol. Normally, this is where we jump straight into their latest financial report, but this particular filing is less about popping revenue numbers and more about a crucial battle for survival on the stock exchange. See, Intensity Therapeutics found themselves in a bit of a pickle. The Nasdaq, that big stock exchange they trade on, has rules. One of those rules is that a company's stock price needs to stay above $1 a share for a certain amount of time to keep trading there. It is kind of like a minimum entry fee to stay in the big leagues for Intensity. Their stock price dipped below this $1 mark for a while, and the Nasdaq sent them a letter about it back in June of 2025. They were given 180 days until December 3rd of that year to fix it. Now, here's where things get interesting. As that deadline loomed, Intensity didn't magically get their stock price back up. So on December 4th, 2025, they got another letter from Nasdaq. This new letter, and this is key, gives them an extra 180 days until June 1st of 2026 to get their act together. This second chance comes with strings attached. Though Nasdaq isn't just giving them free time, they're saying, okay, you have until next summer, but you absolutely have to meet all other listing requirements, like having enough of your stock publicly traded, and you have to have a plan. And what is this grand plan they presented Nasdaq? Well, they told Nasdaq they intend to execute a reverse stock split if necessary. Think of a reverse stock split like this. Imagine you have 10 shares of a company, and each share is worth 20 cents. That is $2 total. Right? A reverse stock split could combine those 10 shares into one share, and now that one share is worth $2. The total value stays the same, but the price per share goes up. Companies do this to artificially boost their stock price to meet exchange requirements, and maybe appear more attractive to investors who might shy away from penny stocks. Nasdaq has made it clear though, if Intensity wants to stay listed, they need to get their stock price above $1 for 10 consecutive business days, or they can do that reverse stock split. But here is a critical detail: if they choose the reverse split route, they have to do it at least 10 business days before that June deadline. They can't wait until the last minute. If they miss this deadline, Nasdaq says their stock will be delisted. Then the only option is to appeal to a hearings panel, and Nasdaq's letter suggests that these panels usually only accept a reverse stock split as a solid plan to fix this kind of problem. For now, an indicator will show on Nasdaq's system that Intensity is not in compliance. A list of all companies that aren't meeting listing rules is also posted online, with the reason for their non-compliance. Intensity will stay on that list until they regain compliance. Importantly, this second notice doesn't mean their stock is being delisted, right this second, as long as they keep meeting all the other Nasdaq rules. The company says they are actively watching their stock price and are ready to consider all options, including that reverse stock split, to keep their shares trading on Nasdaq. It is a clear sign that management is aware of the urgency and is trying to avoid what would be a major blow, being kicked off the main stock exchange. Now, this filing also points to some external communications they put out. They released a press announcement on December 5th, 2025, which likely details their situation and strategy. It is common for companies facing these kinds of challenges to communicate their plans to investors, even if the news isn't exactly celebratory. And as expected in any SEC filing, there is a whole section dedicated to cautionary statements. This is where the company warns that their actual results could be very different from what they're hoping for. They mention risks and uncertainties described in previous reports, like their annual report filed in March and quarterly reports throughout the year. This is standard legal language, but it highlights that even with a plan, there are no guarantees in the stock market, especially when you are battling to stay listed. So, what is the story here? Intensity Therapeutics Incorporated is in a fight for its life on the stock market. They've failed to meet the minimum stock price requirement for Nasdaq, and they've been given an extension to fix it, with their primary stated strategy being a reverse stock split. This isn't a sign of booming business success, it is a sign of a company struggling with its market perception and facing potential delisting. From a Warren Buffett perspective, this situation is a flashing red light. A company that can't maintain a share price above $1 often signals underlying issues with its business model, its growth prospects, or investor confidence. While a reverse stock split can temporarily fix the price, it doesn't magically fix the business itself. The real question is, why is the stock price so low? Is it poor financial performance, lack of promising products in their pipeline, or intense competition? The filing doesn't give us deep financial tables to analyze here, which is unusual for a typical day, but understandable given the focus on the listing issue. However, the lack of positive financial indicators that would naturally push the stock price up is in itself a negative indicator. The biggest risk for Intensity is clearly delisting. Being removed from Nasdaq would severely limit their ability to raise capital, make their shares less liquid for existing shareholders, and generally hurt their reputation. The opportunity, of course, is successfully executing their plan and regaining compliance, which could lead to increased investor confidence if they demonstrate actual business improvement alongside the price fix. However, the path forward seems precarious. The focus on a reverse split suggests they anticipate a significant struggle to organically achieve the required share price. In conclusion, Intensity Therapeutics is in a critical phase. Their immediate future hinges on their ability to either magically boost their stock price significantly or successfully navigate a reverse stock split while simultaneously addressing whatever fundamental issues are causing their stock to languish. It is a tough spot to be in, and investors will be watching very closely. Alright, that is our breakdown of Intensity Therapeutics' latest filing. What is your take on their situation and their plan to stay on Nasdaq? Drop your thoughts in the comments below. If you found this deep dive valuable, please hit that like button, it really helps us out, and subscribe for more corporate decoding. And don't forget to join our Discord community. Linked in the description for more discussions. Thanks for watching, and we'll see you in the next one.